The bear case for Hecla is primarily a valuation argument, supported by concerns over historical share dilution and the contingent nature of its recent asset sales. Hecla Mining is currently trading at a substantial premium compared to its peers and historical averages. Its P/E ratio, reported between 48x and 80.7x by various metrics in early 2026, is significantly higher than the U.S. metals and mining industry average of approximately 24x. While Ols argue that this premium is justified by the company's low-risk jurisdictions and silver focus, bears contend that it leaves little room for operational setbacks. Simply Wall Street's DCF models suggest the stock could be as much as 68.6% overvalued at current prices.
Historical share dilution. A recurring concern for long-term investors is Hecla's history of equity issuance. Over the last decade, shares outstanding grew from 357 million to 623 million, a 74.5% increase. By early 2026, the share count had further expanded to 670.3 million. This ongoing dilution means that even as net income and production hit records, the gains on a per-share basis are dampened. In 2025, while net income surged by over 1,000%, the diluted EPS of 49 cents reflects the heavy weight of the expanded share base. Counterparty and contingency risk in the Casa Berardi sale. The headline value of the Casa Berardi sale is up to $593 million, but only $160 million is guaranteed cash. Over half of the total consideration is deferred or contingent on factors outside Hecla's control, such as Orizone's ability to obtain permits for the WMCP and principal pits, and the future price of gold. If Orizone fails to execute its transition to surface mining, or if the Abitibi-Winnie First Nations concerns over Aboriginal rights lead to legal delays, Hecla may never realize a significant portion of this deal's value.
Mining remains a high-risk industry. The 2026 guidance for lower silver production at Greens Creek highlights the risk of grade volatility. Furthermore, inflationary pressures are manifesting in labor costs, particularly at Lucky Friday, where profit-sharing payments are expected to drive AISC higher in 2026. Any technical failure at a single asset, such as the fire-related suspension at Lucky Friday in 2023, can have a disproportionate impact on the company's consolidated financials. The bull case for Hecla Mining is centered on its position as a high-margin, low-risk, pure-play silver producer that is currently undergoing a massive earnings breakout. Hecla has demonstrated a consistent ability to meet or exceed its production guidance. The 2025 performance, where every primary silver operation hit the top end of guidance, reinforces management's credibility. In a high-price environment, Hecla's operational leverage is immense. With silver prices realizing at nearly $70 per ounce in Q4 2025, the company delivered a $51 margin per ounce against an AISC of $18.11. If silver prices maintain or exceed these levels, the free cash flow generation will likely exceed $1.6 billion annually, assuming the successful execution of the 2026 production plan.
Unlike many of its peers who operate in politically volatile regions like Mexico, Peru, or West Africa, Hecla's operations are concentrated in Tier 1 jurisdictions: Alaska, Idaho, the Yukon, and Quebec. This reduces the risk of resource nationalism, windfall taxes, or sudden permitting cancellations. The 2026 exploration and pre-development budget has been set at a record $55 million, nearly double the 2025 investment. This investment is focused on near-mine targets at Greens Creek and Keno Hill, as well as high-grade targets in Nevada's Midas and Aurora districts. By aggressively expanding its reserve base during a bull market, Hecla is securing its long-term production profile and providing investors with organic growth potential that supplements price-driven gains. Company Deep Dive: the strategic pivot, divestiture, and portfolio optimization. The most significant catalyst for Hecla's current valuation reset is the definitive agreement to sell its subsidiary, Hecla Quebec, which includes the Casa Berardi mine and the Heva and Hosco exploration projects, to Orizone Gold Corporation. This transaction, announced in early 2026, is valued at up to $593 million and represents a definitive shift toward a silver portfolio. The divestiture is a calculated maneuver to concentrate capital allocation on assets that offer higher leverage to silver prices, which management believes will outperform gold in the current macroeconomic cycle.
Financial architecture of the Casa Berardi sale. The structure of the Casa Berardi deal is meticulously tiered, reflecting both immediate liquidity needs and long-term participation in the asset's potential. Hecla is set to receive $160 million in upfront cash at the closing, which is targeted for the first quarter of 2026. This immediate cash infusion is earmarked for debt reduction and the acceleration of exploration programs at core silver sites. In addition to the cash, Hecla will receive approximately 65.7 million Orezone common shares, representing a 9.9% equity stake, and making Hecla a cornerstone investor in the newly diversified Orezone. The contingent consideration, which comprises nearly 40% of the deal's total potential value, introduces a strategic hedge for Hecla. The production-based royalty payments are particularly robust, calculated at $80 per ounce for the first 500,000 ounces produced from future open pits, WMCP and Principal, and rising to $180 per ounce thereafter. This structure ensures that Hecla continues to benefit from the gold bull market without the operational burden of sustaining the mine's high AISC, which was guided at approximately $2,150 per ounce for 2026. However, this also transfers significant permitting and execution risk to Orezone, as the realization of these royalties depends on the successful expansion of surface operations.
The divestment of Casa Berardi fundamentally alters Hecla's revenue profile. In 2025, silver represented 59% of the company's revenue. Upon the successful conclusion of the Orezone transaction, the silver revenue mix is anticipated to surge to approximately 73%. This concentration is designed to attract institutional investors and exchange-traded funds that prioritize silver exposure, as Hecla will increasingly be viewed as one of the few large-cap North American domiciled silver producers. Operational performance. Hecla's operational narrative in 2025 was defined by the successful recovery of the Lucky Friday mine and the rapid optimization of the newly acquired Keno Hill asset. The company achieved its top-end production guidance for silver, delivering 17 million ounces on a consolidated basis. Greens Creek in Alaska remains the fundamental driver of Hecla's cash flow. In 2025, the operation produced 8.7 million ounces of silver at the top end of guidance. The mine's ability to generate silver at an AISC of -$2 per ounce, after accounting for gold, lead, and zinc byproduct credits, provides a massive competitive advantage. This low-cost structure is supported by high-grade ore and a 5% improvement in milled silver grades observed during the 2025 fiscal year.
For 2026, Greens Creek is guided to produce between 7.5 and 8.1 million ounces of silver, a slight decline reflecting anticipated lower milled grades as the mine plan moves into different zones of the deposit. Despite this, the mine remains the cornerstone of the company's reserve base, having added 3.7 million ounces to its model and net reserves growing by 2.4 million ounces after replacing 9.5 million ounces mined in 2025. The Lucky Friday mine in Idaho achieved a historic milestone in 2025, producing a record 5.3 million ounces of silver. This follows a challenging 2023, where production was suspended due to a fire in the secondary escapeway. The rapid development of a new 1,600-foot ramp and vertical escapeway allowed the mine to restart on schedule in January 2024 and ramp up to full capacity by the end of the first quarter. Current capital investments at Lucky Friday are focused on a surface cooling project, scheduled for completion by mid-2026. This project is deemed critical for maintaining underground temperatures as mining moves deeper, and it is expected to support the mine's 17-year reserve life. However, the cost of this operational success is reflected in the 2026 guidance, where Lucky Friday's silver cash costs are expected to rise to $10.25 to $11 per ounce, with an AISC of $23.50 to $26 per ounce. These higher costs are largely attributable to the profit-sharing payments triggered by record-high silver prices, which effectively link labor costs to commodity performance.
The Keno Hill asset has rapidly matured under Hecla's stewardship. In 2025, it produced 3.02 million ounces of silver, achieving first-year profitability and positive free cash flow. The mine benefits from exceptionally high grades, averaging 29.0 ounces per ton. Hecla's strategy at Keno Hill focuses on a throughput rate of 440 tons per day, which is expected to drive robust free cash flow and support an accelerated capital payback. Nevertheless, the site presents complex reclamation obligations under the Canadian ARSA framework, representing a long-term environmental and financial risk that management must mitigate. Financial strength and balance sheet transformation. The 2025 fiscal year was a period of balance sheet transformation for Hecla. The combination of record production and soaring realized metal prices, which reached nearly $70 per ounce for silver in the fourth quarter, enabled the company to achieve unprecedented levels of liquidity and deleveraging.
Hecla reported record revenue of over $1.4 billion for the full year 2025, a dramatic increase from the $720 million reported in 2023. Net income attributable to shareholders rose to $321.7 million, or 0.49 cents per share, compared to a net loss of $84 million in the prior year. This surge in profitability resulted in record adjusted EBITDA of $670 million, allowing the company to aggressively pay down debt. The company's cash position grew ninefold year over year, ending 2025 with $241.6 million in cash and cash equivalents. This strong liquidity profile is further bolstered by the expected $160 million in cash from the Casa Berardi sale, positioning Hecla for a potentially debt-free balance sheet by late 2026 at current commodity prices. Deleveraging has been a core pillar of the 2025 financial strategy. Gross debt was reduced to $276 million, and the net leverage ratio plummeted from 1.6x to 0.1x, a 94% improvement. This reduction in leverage is critical for a cyclical mining company, as it provides a buffer against potential commodity price corrections and allows for the financing of growth through internal cash flows rather than expensive debt markets or equity dilution.
In the competitive landscape of silver mining, Hecla occupies a unique niche as a large-cap North American producer. Its performance over the last year has significantly outpaced its primary competitors, leading to a widening valuation gap. Hecla's operating margin of 30.5% is robust, though it trails some diversified miners like Fortuna Mining, 31.5%. However, its revenue growth of 45.6% in 2025 reflects its strong exposure to the silver price rally. On a price-to-sales (PS) basis, Hecla trades at a forward multiple of 4.48x, which is a premium to Pan American Silver's 3.38x. This premium is largely attributed to Hecla's safer jurisdictional footprint and its more concentrated silver identity following the Casa Berardi sale. Conclusion. On one hand, Hecla is fundamentally stronger than at any point in its history. It has navigated technical crises at Lucky Friday, integrated Keno Hill profitably, and deleveraged its balance sheet to near-zero net debt. The strategic pivot towards silver timed perfectly with a structural global deficit and surging demand. On the other hand, the market has not ignored these successes. Hecla's valuation multiples reflect a high degree of optimism, trading at a premium to the sector and potentially above its fair cash flow value. The historical pattern of share dilution and the ongoing insider selling activity serve as cautionary signals. Furthermore, the contingent nature of the Casa Berardi sale means that a significant portion of the deal's value depends on future permitting and indigenous relations that are currently strained. The bull case rests on silver's continued outperformance and Hecla's ability to use its record exploration budget to deliver organic growth. The bear case rests on the potential for a valuation reset if commodity prices consolidate or if operational execution at the core silver assets falters.